Do you own a business and do you accept credit cards? If so, you're gonna want to listen to this. Today we're talking about how credit card processing companies take money from your pocket and put it into their pocket. They do this with a variety of different credit card processing models. There are a few that you as a business owner get to choose from, and I'm going to go over the 3 that are the most popular and the one that I think is the best. Most people are familiar with flat rate pricing. This is what companies like Square use. They charge one flat rate per transaction, regardless of the transaction amount or the credit card used. The only variation to their charges is that swiped credit cards have a lower rate than keyed-in credit cards. Later, when we dive into Interchange-Plus pricing, you will understand why companies like Square charge the flat rate percentage that they do. The next popular pricing model is tiered or bucket pricing. With tiered pricing, you are quoted a qualified rate, and maybe you're quoted a mid-qualified rate and a non-qualified rate. Salespeople will make it seem like all of your transactions will be charged the qualified rate. But in reality, 90% of your transactions will fall into the much more expensive mid and non-qualified tiers, with most of those transactions falling into the most expensive non-qualified tier. It might sound something like this. Yes, Mr. Business Owner, your qualified rate is 1.5% plus 10 cents. 1.5% plus 10 cents for all my transactions? That sounds amazing. Who wouldn't want to hear that rate? But they are not quoting you the mid and non-qualified rates, which are much higher. Both flat rate and tiered pricing models are more like retail pricing, where the price you pay includes the markup. Finally, let's talk about Interchange-Plus pricing, also known as wholesale pricing. This model is more like Costco, where you pay the wholesale rate set by the credit card networks. It's transparent, but it can be confusing. When a bank issues a new credit card, they set the total cost that you pay when that credit card is accepted. And each card that is issued may have a different wholesale rate or interchangeable fee, thus the term interchange fee. This rate must be high enough to cover credit card rewards such as 2% cash back, airline miles, or other rewards. These credit card rewards aren't paid for by the bank that issues the card. They are paid for by you, the business owner, when that card is accepted. With Interchange-Plus pricing, you pay the wholesale rate for each transaction, meaning you pay the lowest possible rate available for that given card at that time. Now, credit card processors also need to make money, so credit card processors charge a small fee on top of the interchange fee. This small markup is the credit card processor's profit margin. Wholesale costs vary, but on average, in aggregate, they are around 1.7% for Visa, MasterCard, and Discover, and they're a little bit higher, around 2.5% for American Express. Now, when you see that range of fees, it makes more sense why companies like Square charge 2.6% per swipe. Because regardless of the card swiped, on average, they always cover the wholesale costs from the card issuing banks. So with flat rate pricing, you pay the rate as if you are accepting the most expensive credit card every time. Same thing with tiered pricing. Very few cards have an interchange fee lower than the qualified rate of 1.5%, which explains why 90% of transactions downgrade to the higher cost tiers. Although Interchange-Plus wholesale pricing typically leads to cost savings, it doesn't always, depending on the processor that you are with. Some processors have a very high markup above the wholesale rate, so it is very important to speak with somebody who knows what they're talking about in the industry. Unfortunately, this industry is a revolving door. New salespeople are coming in off the streets every day, entering these companies, and they're talking to you on the phone about what is best for your business. Chances are you aren't going to speak to somebody with much industry experience, and many don't really know what they're talking about. They're just going to tell you what you want to hear to get the sale. Yes, 1.5% plus 10 cents sounds great, but that isn't what is actually on the contract when you sign. If something sounds too good to be true, then it most likely is. Another common mistake I see is business owners simply look for the best deal on hardware. It may seem like a great deal to get a $2,000 POS system for just $500, but chances are you are paying that discount back tenfold with higher rates or hidden miscellaneous fees. And once you figure it out, it's too late because you're locked into a 3 or 4 year contract. If you don't know what to say in this situation, it may cost you thousands just to cancel the service to move on to a better provider. Also, be aware of long-term hardware leases. This is where you get the same $2,000 point-of-sale system for $99 a month. At the end of the lease term, you will have paid 2 or 3 times the value of that system, and you still likely will not own the hardware. In my experience, it is almost always better to pay for the hardware in whole up front. You will save a lot more money in the long run, and you will save yourself a lot of unnecessary headaches. So it's important to be aware, it's important to ask questions, and it's important to know which questions to ask. If you need help assessing your credit card processing fees, or if you want us to review a deal that you have been offered, we'd be happy to help. Simply find our contact information on our profile page or on our website. I have personally helped hundreds of business owners just like you to save money and find the best deal. My industry experience is at your disposal, and I can't wait to hear from you.